What if I told you that in 2018, one phone call could have changed the entire trajectory of the global economy? A call that China never answered. A call that would have prevented the largest economic decoupling in modern history. Today, I'm going to reveal what happened behind closed doors, the economist who saw it all coming, and why what happened next is reshaping your financial future right now. Before we dive in, let me ask you something. Have you noticed your iPhone getting more expensive? Have you seen your investment portfolio acting weird lately? Have you wondered why suddenly everyone's talking about moving factories out of China? It's all connected to this one moment. And by the end of this video, you'll understand the global chess game that's been playing out while most people weren't even watching. The economist I'm talking about is not some random talking head on cable news. This is someone who advised multiple administrations, someone who predicted the 2008 financial crisis, someone whose models are used by central banks around the world. And in late 2018, this economist was making phone calls. Desperate phone calls, trying to prevent what they saw as an inevitable economic catastrophe. Let me set the scene for you. It's December 2018. The stock market is tanking. The Dow Jones has just had its worst December since the Great Depression. Trump has been president for almost 2 years, and his trade war with China is escalating fast. Tariffs are flying back and forth like missiles. American farmers are getting crushed. Chinese manufacturers are panicking. And behind the scenes, serious economists, the ones who actually understand how global supply chains work, are freaking out. Because here's what most people didn't understand at the time. The US and China weren't just trading partners. They were economically fused together in a way that had never happened before in human history. Chinese factories assembled products with components from 12 different countries. American companies had spent 30 years building supply chains that ran through Shenzhen and Shanghai. We're talking about trillions of dollars of infrastructure, relationships, contracts, expertise. You don't just untangle that because of some tariffs. Or so everyone thought. The economists saw something different. They saw that both sides were playing a game of chicken, and neither side understood that the other side wasn't going to blink. American policymakers thought China would cave because they needed access to U.S. markets. Chinese policymakers thought America would cave because American companies needed Chinese manufacturing. Both sides were wrong, and both sides were about to drive off a cliff. So the economists started making calls to Beijing, calls to Washington, calls to corporate boardrooms. The message was simple: sit down, negotiate, find a middle path. Because if you don't, if you keep escalating, you're going to trigger something that can't be undone. You're going to force companies to choose sides. You're going to weaponize the global economy. And once that happens, there's no going back. China didn't answer. Well, they answered, but they said all the wrong things. They said they wouldn't be bullied. They said they had 5,000 years of civilization and wouldn't bow to pressure. They said their economy was strong enough to withstand anything America threw at them. All the typical diplomatic posturing. But what they didn't say was the only thing that mattered. Yes, let's talk seriously about structural reforms. And here's where it gets interesting. Because The Economist had specific proposals. Real concrete ideas that could have worked. Things like phased tariff reductions tied to measurable changes in Chinese industrial policy, international arbitration mechanisms for intellectual property disputes, gradual opening of Chinese financial markets with clear timelines, stuff that both sides could actually sell domestically. But China's leadership had a different calculation. They looked at Trump and thought, this guy will be gone in 2 years, maybe 6 at most. Why should we make permanent structural changes to our economy for a temporary political problem? We'll wait him out. We'll take the short-term pain. And when the Democrats come back into power, everything will go back to normal. That was the bet. And it was the most expensive bet in modern economic history. Because what happened next wasn't what anyone expected. The tariffs didn't go away when Biden won. In fact, Biden kept most of them and added new restrictions. But more importantly, something shifted in the American consciousness. Both Democrats and Republicans suddenly agreed on something. China was a strategic competitor, not just an economic partner. That almost never happens in American politics. The consensus evaporated overnight. And once that consensus formed, the real changes began. Not just tariffs. We're talking about export controls on semiconductors, restrictions on technology transfer, pressure on allies to exclude Chinese companies from critical infrastructure. The CHIPS Act, pouring hundreds of billions into domestic semiconductor manufacturing. The Inflation Reduction Act, requiring supply chains for electric vehicles to exclude Chinese components. Apple started moving iPhone production to India. Tesla built gigafactories in Texas and Berlin instead of expanding in Shanghai. Intel and TSMC started building massive fabs in Arizona. Rare earth processing facilities popped up in Texas and Australia. The entire global supply chain started reorganizing itself. And here's the crazy part. It's costing everyone money. Lots of money. Manufacturing in Vietnam or Mexico or Ohio is more expensive than manufacturing in China. That efficiency that made your smartphone cheap, that's being sacrificed on the altar of national security. Your iPhone 16 costs more than your iPhone 10 did, even accounting for inflation. That's not a coincidence. The Economist predicted all of this. They ran the models. They showed policymakers on both sides exactly what would happen. They explained that once you start decoupling, the momentum becomes unstoppable. Companies can't operate in an environment of uncertainty. They need to know where to build factories, where to hire engineers, where to invest billions in infrastructure. And once they start moving, they don't move back. China's economy started showing cracks. Youth unemployment hit record levels. The property sector, which represented 30% of Chinese GDP, entered a crisis that's still ongoing. Foreign direct investment, which had poured into China for 3 decades, started flowing out. Not all at once, not dramatically, but steadily, relentlessly, like air leaking from a tire. But America didn't emerge unscathed either. Inflation spiked. Supply chain disruptions caused shortages. The cost of manufacturing came home to roost in the form of higher prices. The Federal Reserve had to raise interest rates aggressively, which slowed the economy and made mortgages unaffordable for millions of Americans. The Economist watched all of this unfold exactly as they had predicted. They gave interviews trying to explain what was happening. They wrote op-eds. They testified before Congress. And mostly, they were ignored. Because by that point, the political momentum was unstoppable. Both countries had invested too much political capital. Both had told their citizens that they were standing up to the other side. Neither could back down without looking weak. Now, let me tell you what's happening right now as we speak that most people aren't paying attention to. The decoupling isn't slowing down, it's accelerating. China is building its own semiconductor industry from scratch, investing hundreds of billions of dollars. They're developing their own operating systems, their own software ecosystems, their own financial payment systems. They're creating a parallel technological universe. And America and its allies are doing the same thing in reverse. They're building supply chains that explicitly exclude China. The CHIPS Act isn't just about making semiconductors in America. It's about creating an entire ecosystem, from design to manufacturing to packaging, that doesn't touch China at any point. What does this mean for your money? What does this mean for your investments? Let me break it down in practical terms. First, inflation is going to stay higher than it was in the 2010s. When you have two separate supply chains instead of one integrated global supply chain, you lose efficiency. Efficiency is what kept prices low. Less efficiency means higher prices. The Federal Reserve can try to manage it, but there's only so much monetary policy can do when the problem is structural. Second, certain sectors are going to boom. Defense contractors, obviously, but also companies involved in reshoring manufacturing, construction firms building factories in America, Mexico, and allied countries, semiconductor equipment manufacturers, rare earth processors, renewable energy companies that can build supply chains outside of China. These are the sectors seeing massive government subsidies and private investment. Third, the tech sector is splitting. You're going to have Chinese tech giants that dominate in China, Southeast Asia, parts of Africa, and Latin America. And you're going to have American tech giants that dominate in the US, Europe, and allied countries. If you're invested in big tech, you need to understand which camp each company falls into and what their exposure is. Fourth, emerging markets are the new battleground. Vietnam, India, Mexico, Indonesia, Poland. These countries are becoming the manufacturing hubs that China used to be. They're getting the investment, the technology transfer, the jobs, but they're also getting pressured to choose sides, invest accordingly. Fifth, Currency markets are going to be volatile. China is trying to internationalize the yuan, reduce dependence on the dollar. They're setting up currency swap lines with other countries, trying to do oil deals in yuan, building alternative payment systems. It's not going to replace the dollar anytime soon, but it's going to create friction and volatility. The economist I've been talking about is still out there, still trying to get people to understand what's happening. They're warning that we're not just witnessing an economic decoupling, we're witnessing the end of the post-Cold War order. We're going back to a world of competing blocks, of spheres of influence, of parallel systems that don't talk to each other. And here's the thing that keeps them up at night. Once you have separate economic systems, once you have parallel technology ecosystems, once you have competing currency regimes, the risk of actual conflict goes up dramatically. Because economic interdependence was the glue that kept the peace. When American companies have trillions of dollars invested in China, when Chinese factories are making products for American consumers, both governments have a strong incentive to avoid conflict. But when those ties are severed, when each side has built systems that can function without the other, the calculus changes. The economist isn't predicting war. They're just pointing out that the mechanisms that prevented war are being dismantled. And nobody seems to be building new mechanisms to replace them. So what should you do with this information? How should you position yourself financially? Diversify across the new blocks. Don't put all your eggs in the American basket or the Chinese basket. Have exposure to both, but also to the swing countries in between. India is playing both sides brilliantly. Mexico is benefiting from nearshoring. Vietnam is attracting manufacturing without fully committing to either camp. Invest in resilience, not just efficiency. Companies that have diversified supply chains that aren't dependent on any single country are going to outperform. Companies that are still heavily exposed to China without alternatives are taking on geopolitical risk that most investors aren't pricing in. Pay attention to semiconductor supply chains. This is the most critical technology of the 21st century. Whoever controls advanced chip manufacturing controls the future of AI, quantum computing, military technology, everything. The battle over semiconductor supply chains is the battle that will define the next decade. Watch the currency markets. If you think the dollar's dominance is eternal, you're not paying attention. It's not going to collapse tomorrow, but the move toward a multipolar currency system is real. Hold some assets in different currencies. Consider gold as a hedge against currency instability. And finally, accept that the world is changing. The era of cheap goods from China is over. The era of seamless global supply chains is over. The era of American companies operating freely in China is over. We're entering a new period, and it's going to be messier, more expensive, and more dangerous than the last 30 years. The call that China didn't answer in 2018 was a chance to manage this transition peacefully, gradually, rationally. Both sides could have made concessions. Both sides could have found a middle path. But pride, politics, and miscalculation got in the way. And now we're living with the consequences. Trillion-dollar supply chains being rebuilt from scratch. Decades of economic integration being unwound. The global economy splitting into competing blocks. All because nobody picked up the phone and said the one thing that needed to be said, let's make a deal. The economist who made those calls is still working, still analyzing, still trying to chart a path forward. They're not optimistic, but they're not pessimistic either. They're just realistic. They understand that economic systems are shaped by human decisions, and humans are messy, emotional, and often irrational. The best we can do is try to understand the forces at play and position ourselves accordingly. So that's the story. That's the call China didn't answer. That's what happened next. And that's why your world is changing in ways that most people don't fully understand yet. But now you do. Now you're ahead of the curve. Now you can make better decisions about your money, your investments, your future. Because in the end, geopolitics isn't some abstract thing happening far away. It's the reason your phone costs what it costs. It's the reason your portfolio performs the way it performs. It's the invisible hand shaping your economic reality every single day. And the people who understand that, who see the connections, who follow the money across borders and through power structures, those are the people who thrive in times of change. The game has changed, the rules have changed. And the people who understand the new rules are the ones who are going to win.